Here we are looking at Gary Glover's weekly report, and we're going to be covering the indices and understanding how the cycles and patterns can influence the outcomes that they can have. But then also the next layer down, we want to understand within the indices which thematics or which companies we're best to be paying our attention to, learning from both history lessons of market cycles before, but also the opportunities and what the charts are presenting in front of us. So Gary, we love the format that you've got here. We're in the new financial year. We've got the markets still up where they are. Is there much of an update on those markets and technical perspective for the US indices, or is it continuation?
Yeah, I think you're seeing we saw a few distribution days on the NASDAQ and quite a few less on the S&P and less again on the Dow. So they're all kind of showing dips there. So the NASDAQ's been the most volatile there. But, there feels like there's lots of different components within that. There's sort of, if you follow the US momentum guys, they talk about sort of two markets here at the moment, sort of the chips that are starting to stall here and get a bit volatile, and some of the software companies are starting to recover in that regard. So there's sort of two different markets still almost sort of playing out there. But there's just this sort of move here, even though there's a bit more volatility, which often does come when you sort of can get a bit of a topping pattern there, it still feels a bit sort of sideways orientated here. So in particular, the S&P and the Dow just seem to be sort of showing a little bit more strength there, and the NASDAQ there. I still think it's sort of short of that key level there. So far, each expansion there is sort of it's been a sort of 100% of that prior range. If we're going back to that, sort of the tech rec sort of that range there. So so just each expansion sort of been in line there. So I just still feel like there's still got a little bit further to go here. So to me, it still seems like a pause there. Kind of the encouraging aspect is that we normally sort of see this seasonal period here. We normally run, the end of June, sort of up to early August, is seasonally sort of strong period in midterm years. But that August through to October, Chris, is the riskiest. If I'm looking at the cycles each year, I try and find there's usually a 2 or 3 month window every year that's your danger zone for the year, and that is August through to October for midterm years. That's the period there you've really got to be either sitting out or got to be hedged or got to be preparing for just tightening up your stops anyway. So that's sort of when you sort of got to start to play defense there. So hopefully we'll get another little push here and go slightly higher here, and then we can get defensive after we have this push there. Because as we know, sometimes if you get too defensive too early, you can miss a lot. Yeah, you can miss that acceleration. We know over time, sometimes those sort of trends that build, the last leg of that trend can be pretty hard and fast as well. So we just don't want to miss the last part here as well. So to me, this looks like a bit of a pause, and we'll see if we can sort of kind of build from here. So just not sort of when the NASDAQ's the only one showing any distribution really. So the other markets aren't. S&P isn't showing too much distribution. It's a little bit loose, but not too much. That Dow chart's probably the most interesting one. When I look at that longer term trend line sort of building up from that sort of 22 low. So there is a bit of a zone a little bit higher here, and that has actually had some pretty good expansions from that 22, 23 to 22 sort of bear market there, or that sort of pullback there. So each sort of expansion has sort of hit a key level there. So the next one's about 53.3. So that's looking like a pretty good short-term target there for it, and that happens to be up around that upper trend line as well. So oftentimes we normally hit those trend lines, and then we sort of we can skirt along them for 2 or 3 weeks as well. So we might sort of go up here in the next week or two, or maybe we'll grind against it for another 2 or 3 weeks as well. But if we start to see sort of 2 to 4 weeks of sort of resistance at that overhead line and maybe that expansion point there, that'll be sort of ideally what we want to what I think we might sort of see on that on that side. So but the markets I say I still favor another leg up here. I know we're extended here, all the rest of it, but just not sort of seeing the classic sort of signs there at the moment. It just still seeing the rotation underneath there, Chris, as well. So just normally if we're reaching an important peak here, you're normally seeing the majority of the market either peaking or already on the way down as well. We're starting to see the underbelly starting to weaken off underneath, and then it's the last names do all the heavy lifting at the end. So we're just not seeing either of those at the moment. So, yeah.
Okay, so that's the US markets, the indices, what to look for in the next couple of weeks. But you're talking about the rotation. Before we look at the individual companies and the sectors, is there anything more to add to the Aussie as we're still just in that sort of that sideways band that we looked at before? So nothing new to see there.
Yeah, it's funny. I sort of looked at those ranges there probably about 8 weeks ago. I thought, okay, that's we might be, that might be the range we might get stuck in. Well, that's exactly, and from the first week to 7 weeks later, not much has changed. So it's really pretty sort of boring, sort of sideways orientated action here. So, as we know, our market can get in that sort of caught range, and there's a bit more value orientated stocks in the Aussie market too. So, just interesting. We start to see some of the value sector starting to improve here as well. So, so I think again, you're seeing rotation within our market, so that's pretty healthy. But it's for the index there, it's probably just going to grind away here.
Okay, so while it travels sideways, there's always movement within the market that you're talking about, the rotation side of things, which would mean that we have some companies falling out of favor, and other ones that have been out of favor start to then move up and get more positive investment, more positive interest, and then from a technical perspective, breaking out as well. So ALS, I like that you've got these two red lines for us that show us it coming to a contraction in the sense of less volatility and a pointy end, but then breaking out above this overhead resistance has been that downtrend line. What's more important here, the trend line or a bit of a B wave or a swing high be broken, or you really want to see both? What's the critical part for ALS there?
Yeah, I mean, just probably showing a bit of strength first. The market has been pretty weak here, and then just coming through, starting to break through the upside of that trend line. Not the greatest volume there. So since this report here, actually, I think we've had 1 or 2 days up, and then we've actually broken down here today. So if it actually breaks below that trend line, it hasn't broken below the trend line yet, but if it does break below that trend line, that's sort of something you don't want to see. You don't want to sort of see like a false break out one side and then a move the other way. So it's a bit like a rectangle, if it's sort of pierce one side and then all of a sudden you come the other way. It's pretty negative. So so that's right. So you just got to watch that today closely here. May actually not might break down here. So so not looking good. But that's to be honest, that's quite common
in this market.
At the moment. So we're getting a little breakout and then sort of failing here. So hence why if you want to basically sort of trade it, I think you're going to be super tight there. I'll be using that sort of that low there almost basically. That exactly. Keep it nice and tight here. You just don't want to if you're wrong here, you want to lose small here in this market. Don't want to lose big.
As I was told to me when I first started, you need to learn to embrace the small loss, and the small loss is far better than a big loss. And what you've just described there for ALS or ALQ is that it's really important to be flexible in our trades that we identify. And if we're proven wrong or our thesis doesn't roll out or unfold the way that we predict, then it's okay to say, okay, I was wrong. The thesis didn't play out. I need to be out of that trade. I'll preserve my capital and move on to the next opportunity, which may or may not be Regis Healthcare. So I'm seeing the same situation here where you've got the downtrend line, the uptrend, it's narrowing, it was coming into a point. It did something very similar to what we just saw with ALS and ALQ. Broke out, went on for 2 days and then sort of started to give it back up, but didn't break back into below this trend line. Is that sort of a critical differentiator, that the low that was created didn't come back into the pattern?
Yeah, I saw a highlight of this pattern there, Chris, because this is, even though it's a bit more advanced there, this is typically what has been happening. Some breaks, basically breaking out them coming back and retesting there. And one thing I've been looking for is actually to watch those breakouts, not to trade the breakout like I normally do, is actually wait for the retest there and maybe come back to that, that 10 or 20. I really, sounds funny, I'm with industrials there. I'm really liking the fact that they'll at the moment they're coming back to that 20-day moving average, with a lot of regularity. So that's sort of giving you the better entry, particularly if you sort of see it pull back on lighter volume there. So if it pulls back and the volume starts to get a bit heavy, then I think that gives you probably an out from the trade, because it's sort of, I think you really need to tick a lot of boxes at the moment to get good trades here. So I think if it doesn't look quite right, if it breaks out on sort of low volume and then it sort of pulls back on heavier volume, then you just got to be a little bit, I think you just want to be seeing perfect setups so you don't get in the habit of taking any trade here, just because we're just seeing a lot of failures and a lot of sort of false breaks here. So I'm just sort of trying to trade a bit lighter here at the moment.
Well, the next one in the list that you've got here is Ramelius Resources, and gold stocks. We're now here. Let's see, it was Department of Economics, Industry and Science did their quarterly report, and we see that gold was Australia's largest export behind iron ore and has overtaken both coal and LNG, or natural gas. So good revenues particularly from the high gold price. But the gold miners don't tend to show that in the last quarter, because the pattern has been trending down for their own reasons, which is different to the pure exports of Australia. This is still a downtrend line that's looking to be broken. So is this in a similar sort of fashion to what we've just looked in the last charts, or is this notably different because the lower constraint is still trending down as well? So it's a channel as opposed to like a triangle consolidation.
Yeah, I just noticed a few of those sort of gold names there sort of had that classic sort of ABC correction, Bruce, as well, and had a fairly deep correction too. Like, sort of I sort of underplayed gold on the upside there, but I was definitely wary of it when I got extended there. So, it was too late to be sort of coming in there, because I think, and
there was a gold to oil ratio, which was a great video.
Yeah, we had the gold, but we've had all the euphoria that normally happens lining up, all that sort of stuff there. That should be telling you to sell every piece of gold you've got once you start people queuing up, in the manner that they were. So, but it's now had a fairly large correction here, like a large ABC. So, okay, this is potentially a zone where maybe you can start to build here, and maybe you'll have like if that's like a larger A leg down, even that ABC can be the first leg of a larger correction, and then you normally get a B wave in between, and then you get another leg down. And if we are going to get another leg down later in a year, which will sort of coincide our usual end of year, sort of midterm year sort of sell off, we'd normally want to see a B wave in between. So sometimes B waves can be short and sharp, and other times they can be a time consuming event here. This is not a market where we're sort of seeing grinding type of events here. I think if it does come through here, it could go for a bit of a short, sharp run. I favor a move to the midpoint versus as sort of what would be a good beep. So if I measure that move down, I'm looking for it to go back up to the midpoint. Yeah, something around that high there would be ideal. Just even actually just slightly break it, just because that way people see it's a breakout and then they get excited, and then bang, you get knocked on the head. And but just think we might need to sort of see something here after this sort of correction there. So definitely one to keep an eye on there. Still sort of grinding up here. The good news is that it has pulled back a little bit, and we'd love to sort of see this really tighten up here. So if it tightens up here and then the 50-day tightens up there, and then we sort of come through with a bit of volume, we might get a decent trigger there in the next couple of weeks. So that's definitely one sector I'm keeping an eye on there, just because there could be a short and sharp sort of rally here. And yeah, just a few of those golds are looking a bit oversold here.
If we move to a different sector, travel, well, the Straits of Hormuz, if that opens, then it's not so much directly impacting the flight paths, but it can lead to more airline carriers happier to travel through those regions. So less people holding back on travel, and then faster, more efficient travel routes being reopened. That could be beneficial for WEB Travel Group. So that's sort of the background side of what's happening, but we're all across the news and how it can change every hour. From the technical perspective, we've got this same pattern again. So you've got the narrowing ranges of the while at the bottom half of the chart, so sort of some way trawling out a bit of a base. Then it's broken above the resistance level, and this is sort of very different to the ALS charts that we just looked at in Regis, whereas it broke out and then held really tightly in this rectangle. So based on what you've said today and the last couple of weeks, this one feels like it's a little bit different in that it's been able to hold its ground. Is that just me wishful thinking, or how are you observing it?
Yeah, I just observed the volume profile as well. So we've had pretty good volume on the two rallies there, and then we've seen the volume dry up on the pullbacks, and then we actually got a breakout. Okay, that's interesting. And then so a breakout there, a bit of volume comes in, potentially comes in a bit late, which is always a tiny bit of a worry. Maybe that's side of distribution sometimes, but follows is most important. And what's followed there is pretty light volume on the pullback here. So yeah, so I'm kind of looking at, okay, well, this might, the typical industrial probably come back to the 20-day moving average. So there's a green line there. So maybe we'll look for that for support there. Or, if it's a weak market, it might even come all the way back to the 50-day. And then, ideally what it could do is set up on top of that previous high. Yeah, that one there, yeah. So it might even sort of come back and sit on top of that. That'd be the idea. If it sort of came back there, the volume continued to light up, sit on top of there. So it's definitely what I'm watching here, just because the volume profile looks pretty interesting. Has gone below the 20-day moving average today, Chris, actually, as we speak. So, but no volume in there at the moment. So still not sort of seeing any sort of selling there. So that prior high will be is probably a key zone there, actually, just because we're sort of seeing them sort of build on top of each other recently.
And a different space is Treasury Wine Estates, a company that's reshaping its brand and sticking more with the premium and removing a lot of the breadth from those lesser well-known brands, but it is moving higher. A question that I've got besides the trend lines is, could this be 0, 1, 2, 3, or is that too protracted, too high? Am I trying to find something, trying to draw something that's not there?
Yeah, look, you do have the elements of a basing pattern there. It's probably a little too wide here. And yeah, it's not the classic sort of cylinder that you'd like to sort of see there. So yeah, but at the end of the day, we do want to sort of see those higher lows build up. And yeah, I kind of think that 50-day, even though it's sort of like it's tended to sort of break above the 50 a few times on the way down, and then breaking below the 50 a few times on the way down, but it hasn't spent too much time here. So it's kind of one of those ones here. I kind of think if it actually breaks below the 50 and then back above it, it'll be worth watching. And I just sort of noticed a few things. Even sort of Stockland's was the one that I noticed prior as well. They got the same sort of characteristics. It'll tend to break above the 50, come back and maybe even break below it again. But then if it breaks back above the second time, that's kind of when you're having a look here. So there's a few sort of stocks, again, just kind of you're trying to flush sellers out here, trying to flush the buyers out. So yeah, so what's more important is we just kind of see those consecutive higher lows getting built, that we sort of see some volume, some signs of accumulation on those early rallies, and then we want to see the volume dry up on the pullbacks there. So does sort of, we are sort of seeing a few bases getting built, some stocks that are actually building here, which is kind of encouraging considering where we are in the cycle. But yeah, but if they come back above here, that's what I'm looking for at the moment. Just having studied some of those past sort of stock shares, it's, every stock's got its own personality. So, we're seeing like a stock like PME, going pretty hard at the moment. It's basically been holding the 10-day moving average, whereas like industrials that move a bit slower, they tend to sort of hold that 20 a bit more. And if they're sort of slower again, maybe the 50 is sort of more important. So, yeah, I'm just, I've sort of added those MAs into my arsenal here over the last few years. Just noticing a few more obvious observations with those. It's sort of definitely starting to get more confident. I mean, as we know, Chris, if the stock's above the 50-day moving average, twice as likely to be up next day, than if we're below it. So, we really shouldn't be, I'm feeling like actually bringing that rule into I brought that into my personal trading, but I'm sort of tooling with the idea actually bringing it into the model portfolio moving forward there. Just sort of feel like that would be a good rule. I know sometimes there'll be some great companies that will be on sale there. But if you're waiting for them to get above the 50, you're probably never, you're unlikely to get caught too often. And then you've got a pretty tight, low risk entry and a low failure rate as well. So you're not really taking on heaps of risks, which is, as traders there, we sort of want to get the odds in our favor. So if we're price is likely to go up next day, that's a good risk to wait for. And then if we're risking, if it's tighter and our stops probably maybe half or maybe only 1/3 less than the normal risk, and that's a good risk element as well. So there's a few favorable things to that ideology there, which is I'm almost talking myself into it as I speak about it. So it's something that I think I might actually sort of I'm definitely going to introduce it a lot more often. Just whether I think about maybe in a permanent feature there. But let's see how we go in 2026.
Yeah. Well, just to echo that on what you've talked about, the 50-day moving average. I know I talk about this. It was just Tony Turner's book that convinced me to use the 200-day moving average and only trade above it. Rare circumstances I won't, which have created exceptions in recent times with, say, VCP pocket pivots and the strongest thematics on the launchpad. Set those aside. What I'd noticed is that I went back through my trades and I've recorded every trade and possible trade, so all the trades I didn't take back to 2012. So I've got a lot that I can go through. And when I went through a repository of them to see the successes I had and the ones that I let go and probably could have traded and would have turned it out to be good trades, so the trades I didn't take, which you've talked about before, Gary, I noticed that there was a big change in probability or likelihood of me getting a trade if I bought it under the 200-day or over. And then I also went back and exactly like you described, so sometimes when it breaks over the 50, it then sort of throws back and might get pushed back to the 50 or under the 50. I noticed that also happens a lot with the 200-day moving average. So if I'm trading it out of the base, quite often I won't trade the first breakout through the 200 or when it just gets over the 200. I like it to consolidate and create a bit of a base at the 200 or above it, and then give me a good entry and all the things that you just talked about, a tighter stop, higher probability of a trade. And if I'm going to put my capital at risk in the market, I want all of those statistics and probabilities in my favor, which you're talking about with the 50. So,
I mean, that Pragmaticus is a classic example there. Sort of it bounced up through the 50-day moving average, had a 4 or 5 days above it, and then it sort of drifted off and actually ended up undercutting the 50. Then it sort of squared up for a bit, and then once it pierced the 50, it didn't look back. So see a lot of other stocks break it, come back and sit on top of it, and then go again. So it's a bit like the B wave coming back to the 20-day moving average and then going. I was just definitely seeing that set up quite a lot there. So I know a lot of people look at the 200-day moving average. I know that's Minervini in his template. Stan Weinstein's obviously looking at the 30-week, which is the 150-day. So he's a little shorter orientated. So, but yeah, I mean the 50 days sort of, that might be short compared to some of the longer or some of the other guys look at, but still think that should be a minimum there. But yeah, I do love that sort of break and then a retest. That's the one that I start to see that sort of building again off this, after the first break and it, building on it the second time. That's a really good sign there. It's just a really good setup. So that might be sort of something where I'll look at this year for a number of stocks here.
Well, we'll see how that unfolds and look for another update later in the week. Thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.